The third panel for the day, Unlocking Capital, the growing role of AIFs in deepening India's corporate bond market. This session will explore how alternative investment funds are increasingly influencing and shaping India's corporate bond market. By delving into the regulatory, market, and strategic considerations, experts will discuss how AIFs are helping channel long-term capital into corporate debt space, promoting diversification and enhancing market liquidity. The role of AIFs in diversifying corporate bond portfolios, innovations in debts, financing through AIFs, taxation, and disclosure norms. May I request people standing at the gate to kindly take their seats now? We have a networking lunch post this. I'm sure there's a lot to discuss. We will take a break for that. Everybody, please take your seats. Thank you. It's time to call upon the session moderator for this session. Please give a huge round of applause for Mr. Rohit Gulati, CEO, UTI Alternatives Private Limited. Round of applause as he joins us. Thank you for joining. On the panel, first we have Mr. Ankur Jain, Managing Director, Private Credit Strategies, InCred Alternative Investments. Round of applause. Thank you for joining. Next on the panel, we have Mr. Shekhar Daga, Head Private Capital, ICICI Prudential Asset Management Company Limited. Thank you. Next up, we have Mr. Nagesh Chauhan, Head Debt Capital Market, Tipsons Group. Round of applause. Last on the panel, Mr. Vineet Nahata, Director, Power Guild Treasuries. Round of applause as he joins us. Thank you. Mr. Gulati, I request you to please conduct the session.
Great. Thank you so much. I think this is the last session before lunch. So I think what I'm going to do is I'm going to make sure that the conversation is very crisp and very pointed. So good afternoon, all. This session is about unlocking capital with AIFs providing that additional depth that's required in the corporate bond market. How big is the corporate bond market in India? I mean, it's more than $600 billion. But that's still less than 20% of our GDP. Now, if I compare that market size with the other developed markets, we are talking about numbers from 40% of GDP to 100% of GDP. Now, that's a big opportunity and a challenge. It's an opportunity because if we manage to deepen the corporate bond market, we'll be able to unlock a very sustainable source of capital, which will power our GDP to beyond $5 trillion. But it's a challenge because, frankly, there is very limited liquidity in the market for issuances beyond AAA and sovereign issuances. So if somebody wants to do an A-rated paper or an investment-grade paper, there is no liquidity. AIFs have a very big role to play in this now. The committed capital by June 2025, as per the data submitted to SEBI, the AIF committed capital is close to $158 billion. And within AIFs, private credit AIFs have a big role to play. It is estimated by 2028, the committed capital in private credit would be close to $60 to $70 billion. Now, the private credit fund, and we have like 3 private credit fund managers on the stage. We do buy and hold strategies. We invest in NCDs and we hold till maturity. But imagine if we had the ability to sell that paper in the market, then the sky is the limit for us. Our regulator, SEBI, has really helping us in this journey. Very recently, SEBI announced that while Category 2 earlier were allowed only to invest in listed papers up to 50%, we can now take that number up to 100% as long as the additional securities are A-rated or below. So that's a very major step that will really help us in deepening the corporate bond market. Now, given the paucity of time, the way I'm going to do this, the introductions have already been done. I'm going to go around this panel and ask them a very pointed question. How can we deepen the corporate bond market as AIFs? And I'll start with Ankur, if you can start, and we'll keep the conversation very crisp so that we'll not hold the audience from their lunch.
Absolutely. Rohit, thank you. Good afternoon, everyone. Private credit via AIFs. I think we as a community is taken up this mantle of giving access to structured capital, which is not a binary capital. Like binary capital availability was either equity or loans, right? But for mid-market companies in India, anything which was flexible, anything which was in between equity markets, anything which was non-bank requirement capital, that was not available for a longest period of time because banks were focused and equity markets were focused on large caps, so to say. So mid-market in that sense, mid-market companies in that sense were constrained for the availability of this flexible capital, and hence their growth was also constrained. So we as private credit funds via AIF are giving that kind of flexible capital, or making that flexible capital available for the mid-market companies of this country. And I think mid-market companies really in this country is a backbone of this GDP, of this economy. So in that sense, we being the mantle or we being the capital providers to this important segment of our economy is helping these companies becoming bigger and then basically be able to grow faster. Um, because we deal only with NCDs or only with bonds and the issuers being mid-market companies, so in a way we are also helping the bond market in that sense deepening. Maybe the opening words.
Thanks, Ankur. I think I clearly agree with you. Mid-market source of cap, we've become a very big source of capital for mid-market corporates. And I think that's where the innovation has to happen in deepening the corporate bond markets. Vineet, you have a very specific experience of dealing with EPFO. So, how do you think that your understanding of that provident fund market can actually help us deepen the corporate bond market?
As far as AIFs are concerned, the EPFO has a mandate to invest of 5% of its capital, which is optional. Now, the total corpus of EPFO is close to 25 lakh crore. 5% is roughly 1.5 lakh crore. The irony is that they have just made a small beginning by investing 2,000 crores in the InvITs of National Highway Authority. There's a long way ahead, and if the main issue what we are facing at EPFO is the lack of awareness amongst the exempted provident fund trusts who run their own provident fund investment management, as well as the Central Board of Trustees of the EPFO. So there's another restriction that only PSUs are allowed, the REITs and InvITs issued by only public sector undertakings that are allowed to be invested in the 5% space. So this restriction needs to go away to allow private corporates, the REITs, InvITs, etc., and other AIFs issued by private corporates also to find space in the institutional sector.
Thanks, Vineet. Nagesh, if you want to add anything to that. It's on.
Hello. So my take on that is, currently if we look at the current landscape of corporate bond market, it is largely dominated by AAA to AA issuers. And this restricts or rather have a limitation of access to capital for high growth companies. I will not blame banks because they have regulatory constraints to lend to these corporates with the higher risk weights and the exposure limits that they have. I think AF is playing and will continue to play a crucial role to provide these growth capitals because they assess the risk not by the policies. They assess a corporate by their own risk assessment, and then accordingly they take a call. For papers which are rated below AA, an access to capital becomes very important comparatively to the larger corporates. And hence, I feel personally AF as a catalyst to growth capital continue to play a larger role in the overall corporate bond market.
Thanks, Nagesh. Shekhar, how are AIFs actually helping in diversifying the portfolio itself in the corporate bond market, compared to the traditional mutual funds and the bond issuances?
If you look at the capital location with large investors, so you can just segregate between institutions and family offices. And EPFO definitely, as my colleague said, is looking to allocate capital in AIFs. But today, as we speak, like when an investor wants to allocate capital in fixed income kind of asset classes, you have the bank FDs, you have the mutual funds, but the returns, but the taxation is not an efficient in credit as a whole. So people want to kind of look for asset classes which can give them a slightly higher alpha over what they are getting over their traditional products. And what I have been seeing that family offices and ultra HNIs are looking to diversify their debt portfolio across AIFs, and it can be from a performing credit to a special situation or a distress kind of a underlying investment strategy. So I personally believe like the way it's happening over the next few years, we will see a much bigger participation from the domestic institutions and large family offices where they will be allocating much larger share of capital and they would be bigger participants. So it's all good for managers like us that we will have access to that capital because in India getting capital from traditional sources is not easy. So we need to develop these institutional and family office ecosystem much bigger to get this capital which can be much more flexible for our borrowers.
Thanks, Shekhar. I think the flexibility of structuring is what differentiates AIFs, and that's what's going to actually give a color to the bond portfolio, which is not existing currently. I did mention that SEBI has been a great support by allowing Category 2 funds to invest in listed debentures up to 100% of the corpus. I think what are the other structural reforms do we need for deepening the corporate bond market?
Hedging and risk management is one area where a lot of work needs to be done. Debt markets are exposed to counterparty risk, liquidity risk, and most importantly, price risk. So products like interest rate futures, interest rate swaps, credit default swaps, they need to be more popular and then widely traded. Unfortunately, there is very less traction in this particular segment. So a lot of work needs to be done here. Other than that, the investor awareness about the retail segment. The retail investors need to embrace, there has been a significant progress, but a lot needs to be done there.
Ankur, Vineet briefly referred to the credit risk. What are the innovative strategies that AIFs are following for countering the credit risk, specifically since we are investing in the lower end of the spectrum as far as rating is concerned?
Yeah. So we as AIF managers are not only identifying those mid-market companies who are investable, who need access to capital, deepening the corporate credit market at that end of the thing, but also diversifying the risk for our investors. Investors like yourself, me, institutions, banks, who can invest into our funds and then get access to these kind of strategies, access to these kind of companies who are raising capital, which otherwise in a listed market and a bond market won't be available. In addition to identifying, we as managers are also diversifying the risk. How do we diversify the risk? Point number one, many things, but fundamentally portfolio management. We are taking smaller size exposures, so single party exposure is one, granularity, diversification is one thing that we employ at the portfolio level so that single party exposure in our overall portfolio is not big. It just diversifies the risk of that overall portfolio a lot. We try to create syndicates. If there is a large transaction, we don't do it alone. We also help, or we also take the opinion of our fellow asset managers or AIF managers and see whether the risk is suitable or not. So multiple pairs of eyes in that sense evaluating the same company, and hence we also feel confident that the credit risk that we are taking is good. Taking collaterals, taking adequate security cover, instilling the discipline of financial reporting on the underlying company on a frequent basis. All of this goes a long way in terms of reducing the risk at individual company level and then reducing the risk at the overall portfolio level.
I think, Vineet, you had a point that you wanted to make on that.
As far as the creation of investor awareness is there, the mutual fund Sahi Hai campaign is widely spread. It's omnipotent. Everywhere you see on online media, virtual media, then hoardings, billboards, etc. So AMFI happens to be the body which is undertaking such a mega advertising campaign. if the bond markets, they carry out a campaign to create awareness amongst the investors about the salient features of directly investing in bonds. There are taxation benefits also which are available to the investors. After 1 year, the tax rate is only 12.5% on the capital appreciation. Most of the people don't know about it. So a strong advertising campaign to educate the investors and create awareness about the corporate bond markets and the sovereign debt markets is essential so that the bond markets can be strengthened and deepened.
Thanks, Vineet. You're talking about investors. One big segment of investors are global investors. And with the advent of Gift City, a lot of pooling vehicles are coming into existence in Gift City. As UTI Alternatives, we have set up 3 pooling vehicles for attracting global capital. But obviously, when we try to attract global capital, the question is always, what does the Indian market offers versus what are the opportunities available globally? So, Nagesh, what are the challenges and opportunities that you see in the fixed income market in the next 5 years, keeping into account the global interest rate volatility, which is quite prevalent nowadays?
So coming from a corporate bond house, my take is in the coming 5 years, the corporate bond market would deepen and diversify too, with regulatory reforms in picture and bond index inclusion at a global level will obviously attract capital flows. But in my opinion, because there is a global interest rate volatility amongst all the central banks, it is more like a competition between all the global banks. The capital flow would be more cyclical, both the capital flow and the spreads in the Indian economy would be more cyclical. And hence, I think RBI's role in the policy making like liquidity, forex, hedging policies, along with the distribution of the domestic investor base towards the capital market would try to shorten the damp that will be caused by these global market central banks. Capital flow will continue, and I think it will be still dominated by the 2 key markets of the corporate bond, which is GSEC and AAA, and the spread wings in the credit market would continue to face a challenge. That's my take.
And talking about global investors, one big pool of capital is always development financial institutions. And the DFIs have focused on ESG and also on impact. So, Shekhar, has there been any experience in dealing with DFIs, especially from an ESG standpoint? Because while obviously Mr. Trump is the president and ESG suddenly become irrelevant for the time being, but I think that's something that will always be part of attracting global capital. So, any thoughts on that?
I think if you look at it, most of the impact funds are mostly European, and there has been a decent traction, if I can say, where the funds have been very active in India, more in terms of impact. ESG as a theme, yeah, it yet to take off, yeah, but the green energy and the green funds where people are looking at renewables, there would be a lot of traction out there. But just overall in a global investor perspective, if you, apart from these 2 segments, which by design have to invest in these kind of nature of products, either for impact or social, but like a traditional funds, really the opportunity set in India is very limited, just on the base of scale and also in terms of the risk reward, what they get as compared to a peer markets, maybe in US or in Europe, as compared to what the returns they get in India. So India as a market is like always expensive on equity, on debt we are the cheapest. So maybe we are not the right price market, but yeah, for us like the managers in India, we have to raise money in India and deploy in India. But the global investors have options to invest across geographies. So impact and ESG, yes, they will be doing their business, but we need to find a way where we can get like the bigger global investors also coming into the domestic bond market in a big way.
Vineet, you want to add on to anything on?
As far as ESG bonds and climate change bonds and green bonds are concerned, in India, the greenium is missing. If we just talk about the sovereign green bonds, many a times we see that the sovereign green bonds are trading at a yields which are higher than their similar counterparts of the same maturity. The yields which are there, like the investors are not, as just mentioned by my colleague, the risk return trade-off is not attractive enough to generate good investment value in the green segment. certain measures are there which, if the government implements, it is going to give a big fillip to investment in the green bonds. The classification as of green bonds as priority sector lending, if they qualify for that, it is going to allow a lot of banks to compulsorily invest in green bonds and make way for their subscription in a big way. Tax incentives are also missing. The investor who's compromising on the yields by investing in green bonds compared to the conventional bond, there is no tax incentive to induce him to invest in these green bonds. And more importantly, there's many institutional investors. They are hesitant to investing because of lack of clawback clause which is available in the clawback clause is there in overseas markets, which predominantly are missing in the Indian market. So if these issues are addressed, then the ESG and green segment is going to see a lot of traction flowing in.
Yeah, sure.
So I think, Rohit, just like we are living in a world of, or in the era of independence, self-dependence. So with respect to ESG, climate, impact, I don't think so that we have to look outside. We don't have to look for global impact funds or global DFIs to come to India and then invest into India. AIF is a brilliant way of pooling domestic capital, either retail, family offices, or institutional, and use AIF as a vehicle to, let's say, promote companies or give structured capital to companies which are into budding enterprises, which are into, let's say, electric vehicles manufacturing, or clean energy, let's say, setting up power plants, solar power plants, rooftops or power plants, which is not big capital guzzlers. So they don't come into the radar of large private equity funds or large global funds, but can take benefit of domestic capital. So I think AIF is a very good way of pulling, channelizing Indian retail money into some of these enterprises which are, that sense, small and medium enterprises.
I can't agree with you more, Ankur, because obviously I raised my first fund in November of 2017, and what we see now in 2025 is a very different ballgame. Earlier, to talk about private credit and AIF investing in bonds were very nascent, right? And now obviously we see a lot of money flowing in. And just a last question before we wrap this up. I wanted to be on time. Shekhar, now specifically on underwriting and recovery, right? Banks have certain advantages. For example, access to credit information, access to SURFACE. So do you think these are stumbling blocks from a AIF investment standpoint from underwriting and recovery?
So definitely having a SURFACE and getting more access to information like the way banks have would be an added benefit. But one point which I've been seeing over last few years, and since I've done distress half my career, I personally believe that IBC, the bankruptcy regulation in the country, has been a game changer in terms of changing the credit behavior of the borrower. So definitely these added tools will be a lot of benefit, but just the IBC worry, because people perceive it as like a long drawn process, but the other way to see is that a lot of borrowers are aware that in case they default, they may end up losing their company, and which has been demonstrated through the various court processes. And I personally see a big sea change in the way the borrower behaves. So it is for us to eliminate the wrong set of borrowers in order from the underwriting perspective. And this added tool of a kind of a regulation in both in case of SURFACE and information access which banks have, like because we are lending to the same set of counterparties and they may be borrowers with the bank. So if we understand what is their status in the bank, are they in default or not, I think that added piece of credit information, a bureau report, will really help us to improve our underwritings a lot more actually.
Thanks, Shekhar. I think just to summarize, AIFs is definitely going to be a big source of capital for deepening the bond market. Our regulators have been very, very supportive to us. This is, I think, under the aegis of RBI. We have recently written to RBI to get access to SURFACE and also information rights. And I think the AIF has become a very big source of capital raising, because our efforts on creating awareness globally, and especially through the GIFT City platform, is bringing a lot of new investors in. And I think we are truly on a journey of deepening the corporate bond market. With that, I'll open the house for any questions. We're happy to answer. But I promised Rajesh ji that I'm going to finish on time. Yeah.
if I'm wrong. What is the asset cover that you are looking for when you are investing in your bond?
So we have done around 50 transactions to date. Our average fixed asset cover ratio will be around 1.5 times. But I think every fund manager will have his own views. So, Shekhar, if you want to add something.
I think it's a different style for every fund manager, and somebody may focus on cash flows, somebody may focus on. So there is somebody around a PD and LGD, like maybe I may worry about the probability of default, and somebody on this panel will be okay with the probability of default, and he will worry about the loss given default. So if you want 2x cover, then he may be okay, as long as something goes in default, I will be able to recover. But there will be a certain set of pool of capital where the probability of default itself is a worrying thing actually. So it's a mix of underlying investment thesis which each asset manager follows, and somebody will focus a lot more on cash flows, and maybe a collateral is required for the rainy day, but the collateral may not be the only thing, because his key underwriting thesis is that the cash flows are sufficient enough and have ring fence in some form of escrow or something like that, plus maybe a 1.2 cover, not necessarily maybe a 2 times cover, but it's all different strategies, different structures. You can't like have one structure for everything. So maybe the way I see it, like you have large cap, mid cap, and small cap in equity, and you invest in small cap because you believe there would be multi-baggers. And my belief is the credit also you should see if you want to pay large cap game or mid cap game or small cap game. Small cap means if you want to have 16, 20% of credit, you have to take that kind of risk. It's not necessary that you'll lose money, but the risk would be far higher for the return you want to have. So it's a kind of a spectrum. Again, you have to choose. There are products at 12%, there are products at 15, and there are products at 18, 20 also. Maybe anybody can add.
I think can't agree more with what Shekhar has said. I think perfect analogy with respect to large cap, mid cap, small cap, and depending on which kind of fund is that. If the fund is focused on large cap as a strategy from the credit standpoint, I think 12 to 14%, and then the list keeps on going.
Great, I guess no more questions, and everybody's anxiously wanting to have lunch, so we'll wrap it up. Thank you so much.
Thank you. No more questions for the panel? Okay. Mr. Gulati, thank you so much for being an excellent moderator. Can we have a round of applause for him? And the entire panel, I think this was very interesting. Even though this is the last panel of the day, I can still see a significant amount of people sitting here and listening, taking notes. So thank you so much once again, panelists. And with that, we come to the end of the session. Thank you. I request all of you all to please come forward for a picture together. Thank you, panelists, once again. And with that, I would like to request Dr. Rajesh Singh, Additional Director and Head Department of Banking and Financial Services, ASSOCHAM, to deliver the vote of thanks. Round of applause as he joins us, ladies and gentlemen.
I think this is the lunch time, so I will not take too much time, but this is my duty. So first of all, good afternoon to all. It's always a privilege to extend the vote of thanks in the front of a very learned person. So first of all, I will express to my heartiest, I can say, to S. Raman sir. He is a chairperson for the PFRDA, along with Anant Narayan ji sir. He is a whole-time member of SEBI, along with Mr. Pradeep Ramakrishnan sir. He is the ED of IFSCA. So thank you for your kind presence, and you have given the very insightful address, and we will prepare the recommendation and submit to the SEBI along with the PFRDA and the IFCA. So apart from that, I would also like to express my gratitude to our leadership, particularly on the council leadership. Nipa ma'am, she is a chairperson. She has not only the supported in the last 6 to 7 years, she has made an instrumental role to shaping the entire agenda along with the Aditi ma'am and Mr. Malhotra. Now coming to the special boards and appreciation with our sponsor. Without your kind presence, no, this shows we cannot organize this type of shows. So thank you so much for your kind support. Our special thanks to the CRISIL team. He has prepared a very comprehensive report along with my entire team of ASSOCHAM, led by the Vivek Tiwari and Ankit Krishna and Kushag Joshi. And also, I'm grateful to the Basu sir. He is my leader and he is a cluster head for our unit. So thank you so much, sir, for your contribution. Yaska, thank you so much for your contribution, entire delegate and participant. So thank you so much for your participation. Thank you so much.
Thank you, ladies and gentlemen. That was the end of the 8th Annual Conclave Corporate Bond Market Summit. I request you to please kindly proceed towards lunch. Thank you so much once again for marking your presence. My name is Rishika, and it was a pleasure being the host for today.